Hello, and welcome back to our channel, The Frugal Mindset. Real estate is a popular investment option that has been used for many years to generate wealth and build financial security. In this video, we'll discuss about real estate, different types of real estate investments, and we'll also discuss about the pros and cons of real estate investment. But before moving forward, be sure to like and subscribe our channel. Real estate refers to the physical property and land, along with any buildings or structures on it. Real estate can be categorized into different types based on its use and purpose, such as residential, commercial, industrial, and agricultural. Residential real estate refers to properties that are designed and used for residential purposes, such as single-family homes, townhouses, and condominiums. Residential real estate is typically bought by individuals or families for personal use, or by investors for rental income and property appreciation. Commercial real estate, on the other hand, refers to properties that are used for business purposes, such as office buildings, retail spaces, and hotels. Commercial real estate is often owned by corporations or partnerships and can provide a source of rental income and long-term property appreciation. Industrial real estate includes properties that are used for manufacturing, distribution, and storage purposes, such as factories, warehouses, and distribution centers. Industrial real estate can provide investors with stable rental income and long-term property appreciation. Agricultural real estate refers to properties that are used for farming and agricultural purposes, such as crop fields and ranches. Agricultural real estate can provide investors with a source of passive income through renting out the land to farmers or operating the farm themselves. In addition to these types of real estate, there are also different ways to invest in real estate. Some common types of real estate investment include rental properties. Investors purchase residential or commercial properties with the intention of renting them out to tenants, generating rental income, and potential property appreciation. John purchases a rental property for $200,000 with a 20% down payment of $40,000. He secured a 30-year mortgage with a 4% interest rate, resulting in a monthly mortgage payment of $763. The property generates $1,500 in monthly rental income, with $500 allocated towards property expenses, such as property taxes, insurance, and maintenance. In this scenario, John is able to generate $737 in monthly passive income, which is a 22% annual return on his initial $40,000 investment. Over time, the property may also appreciate in value, allowing the John to build equity and potentially sell the property for a profit. House flipping. Investors purchase distressed properties with the intention of renovating and reselling them for a profit. Anna purchases a fixer-upper property for $100,000 and invests an additional $50,000 in renovations and repairs. She then sells the property for $200,000, resulting in a profit of $50,000 after accounting for expenses, such as closing costs and real estate commissions. In this scenario, Anna is able to generate a 50% return on their initial investment of $100,000 in a relatively short amount of time. Real estate investment trusts, REITs. REITs are investment vehicles that own and operate income-generating real estate properties. Investors can purchase shares in a REIT, allowing them to invest in real estate without directly owning the properties themselves. Maya purchases shares in a real estate investment trust that specializes in commercial properties. The REIT offers a 5% annual dividend yield with a share price of $50. If Maya invests $10,000 in the REIT, she will receive $500 in annual dividends. Over time, the value of the shares may also appreciate, allowing the Maya to sell her shares for a potential profit. Real estate crowdfunding. Crowdfunding platforms allow investors to pool their money together to invest in real estate projects. To determine the potential profitability of a real estate crowdfunding investment, you'll need to calculate the expected return on investment, or ROI, and factor in any associated fees. For example, if you invest $10,000 in a real estate crowdfunding project with an expected ROI of 10%, your expected return would be $1,000, $10,000 into 0.10. However, you'll also need to factor in any platform fees, such as a 2% management fee, which would reduce your return by $200, $10,000 into 0.02. In this case, your net return would be $800. $1,000 minus $200. It's also important to consider the potential risks associated with real estate crowdfunding investments. For example, if the project doesn't perform as expected or if the real estate market experiences a downturn, your investment could lose value. Real estate investment can be a lucrative venture for those looking to build wealth over the long term, but it also comes with its own set of risks and challenges. Here are some pros and cons to consider before investing in real estate. Pros. 1. Steady income. One of the most attractive benefits of investing in real estate is the potential for steady income in the form of rent payments. Rental properties can provide a reliable source of passive income, particularly in markets with high demand for housing. Let's say John buys a rental property for $300,000 and rents it out for $2,500 per month. Assuming the property is fully occupied, he could earn $30,000 per year in rental income, providing a steady stream of passive income. 2. Appreciation. Real estate generally appreciates in value over time, which can provide a significant return on investment over the long term. Property values tend to rise with inflation, and in some cases even faster than inflation, depending on factors like location, demand, and the condition of the property. If Alex buys a property for $500,000 and it appreciates by 5% per year, the value of the property would increase to $525,000 in 1 year. Over 10 years, the property's value would increase to $114,000, providing a significant return on investment. 3. Tax benefits. Real estate investors can take advantage of a variety of tax benefits, including deductions for mortgage interest, property taxes, and depreciation. These tax benefits can help offset some of the costs of owning and operating a rental property, reducing the investor's overall tax liability. If Anna has a mortgage on a rental property, she may be able to deduct the interest paid on the mortgage, reducing their overall tax liability. For example, if Anna paid $10,000 in mortgage interest in a year, she could potentially reduce their taxable income by $10,000. 4. Inflation hedge. Real estate investments can serve as a hedge against inflation, as the value of the property and the rental income it generates typically increase with inflation. This means that the investor's purchasing power is protected, even as the value of the currency declines over time. Let's say Dave buys a property for $500,000 and rents it out for $3,000 per month. Over time, the rental income would likely increase with inflation, providing a hedge against inflation and maintaining Dave's purchasing power. 5. Diversification. Real estate investments can provide diversification to a portfolio, as they have a low correlation with other asset classes like stocks and bonds. This can help reduce the overall risk of the portfolio and provide a more stable return over time. Cons. 1. Market risk. Real estate values can be influenced by a variety of factors, including economic conditions, interest rates, and local market conditions. These factors can make it difficult to predict future returns and can lead to a decline in the property's value, resulting in a loss for the investor. Suppose Daniel buys a property for $100,000 and expects it to appreciate by 3% per year. However, if the market experiences a downturn and the property only appreciates by 1% per year, his expected return will be lower than anticipated. 2. Liquidity risk. Real estate investments can be difficult to sell quickly, and investors may need to hold onto the property for an extended period of time in order to find a buyer and receive a fair price. This can make it challenging for investors who need to access their capital quickly. 3. High upfront costs. Real estate investments often require a significant amount of upfront capital, including a down payment, closing costs, and other fees. This can be a barrier to entry for some investors, particularly those who are just starting out or who have limited resources. If Susan wants to buy a property for $200,000 and needs to put down 20% as a down payment or $40,000, she will also need to pay closing costs and other fees, which could add up to several $1,000s. 4. Maintenance and repair costs. Real estate investors are responsible for maintaining and repairing their properties, which can be expensive and eat into their profits. For example, if a property's roof needs to be replaced or the HVAC system fails, the investor may need to pay a significant amount of money to fix the issue. 5. Interest rate risk. Real estate investments are often financed with mortgages. and changes in interest rates can have a significant impact on the investor's returns. For example, if interest rates rise, the investor's mortgage payments would increase, reducing their cash flow and potentially reducing their overall returns. Real estate offers a range of advantages, including potential for high returns, tangible assets, diversification, and tax benefits. However, it's important to keep in mind the potential drawbacks of real estate investing, such as significant upfront capital requirements and property management responsibilities. Before investing in real estate, it's important to carefully evaluate your investment goals, risk tolerance, and financial situation to determine if it's the right investment strategy for you. Additionally, it's important to consult with a financial advisor or real estate professional to ensure that you fully understand the potential risks and rewards of investing in real estate. Thank you for watching, and we hope that this video has provided you with a helpful introduction to investing in real estate. Don't forget to like and subscribe The Frugal Mindset, and I'll see you in the next one.